Here's something Wall Street won't tell you. Some of the best performing stocks are names you've never even heard of. Often they're inexpensive and they quietly compound gains while everyone else fights over the same handful of overbought mega caps. I literally sorted through thousands of stocks to find four such under the radar opportunities for you today, and they're all trading for under $20 per share. One is a business that's completely rebuilt how it makes money. One is a fantastic turnaround story, shedding years of losses in order to make serious gains. And the one I'm excited about the most is a brand you'll definitely recognize, but they are no longer running the operation the way you expected. Stick around to the end for that one. Okay, I'm Steve Reitmeister, but all my friends call me Righty. I spent nearly 20 years as the editor-in-chief of Zacks.com, and today I'm a partner at WallStreetZen, where every day our quant team analyzes the universe of stocks by 115 different factors to find the ones most likely to outperform. Indeed, all four picks today scored highly in that coveted quant model. If stock reviews like this are useful to you, then do me a quick favor and hit that like button. It tells the algorithm to put more videos like this in front of you instead of the usual hype and nonsense. All right, and before we load up that first stock, just a quick reminder, this is not personalized investment advice. Investing always carries some risk, including the risk of loss. So do your own due diligence before putting real money to work. All right, with all that said, let's kick off the list with Arlo Technologies with the symbol of ARLO. This is a company that has quietly made itself over, and the results are truly exciting. Those of you who recognize the name Arlo likely think of a home security company that sells doorbells and backyard cameras. That's a fine business, but it's a one-time sale with thin hardware margins, so Arlo did something smart. They built a subscription business on top of the hardware, a monthly plan for cloud storage, smart alerts, and AI detection that tells the difference between a person, a package, and a passing car, and that changed everything for Arlo. Subscription revenue now makes up roughly 60% of their business, growing about 31% year over year. Even better, that recurring revenue stream generates gross margins of roughly 85%, helping drive record profitability. That improving margin is how a 31% increase in revenue becomes 86% year-over-year earnings growth in the most recent quarter. Even better, they are now riding a 5-quarter earnings beat streak, flexing some serious earnings momentum. Now, compare that to only selling a physical camera, and you see why profits are climbing so fast. The final part I want to touch on in terms of their business performance is stickiness. They've crossed 6 million paid accounts with monthly churn around 1%, meaning roughly 99 out of every 100 customers stays with them month over month. That's the kind of predictable, repeating revenue investors are ready to pay a premium for. Here's the part that gets really interesting. Only one Wall Street analyst even covers this stock right now. It's highly regarded Martin Yang of Oppenheimer, who ranks in the top 4% of Wall Street analysts for his stock picking performance. He recently started Arlo as a buy, posting a price target that points to 50% upside in the year ahead. Remember, the goal of this video is to find stocks that are flying under the radar with great upside potential. That is clearly the case here with only one analyst covering the stock. This is great news because the growth party unfolds. No doubt more analysts will start to recommend the stock. Each new buy report acts as a catalyst to push shares higher. This benefits early movers into these shares. The Zen Ratings quant model confirms that this is a special opportunity. Arlo carries an elite A rating, which amounts to a strong buy recommendation. As of the week I'm recording, it ranks in the top 3% of all stocks based on that full 115-factor fundamental review. Digging deeper, the Zen Ratings lets us see specifically where a stock shines through the 7 different component grades. These help highlight the strengths and weaknesses of any stock. In the plus column, we find that sentiment clocks in the top 16% of all stocks tracked. Financial strength is even higher in the top 6%. These are signals that say they're a strong operator and the smart money is already moving into shares. The best part of the story is the vital growth component grade, which ranks in the top 1% of all stocks. This is the best signal to foreshadow more growth and earnings beats ahead. Now, this is a quintessential under-the-radar pick. Investors are still asleep on their shift to subscription revenue driving growth. Gladly, the Zen Ratings shines a line on the special opportunity before other investors fully catch on. Finding unique setups like this is exactly what I do every Monday evening in my live training session. It's totally free and includes some of my top stock recommendations. So please join the next one this coming Monday at 7 p.m. Eastern Time. Just go to wallstreetzen.com/live to register for free right now. Let's keep moving with our second stock, which is Alto Ingredients with the symbol of ALTO. Alto spent many years losing losing money, and now they have turned the corner, making the stock worthy of our attention right now. Let's take it from the top. Alto produces specialty alcohols and essential ingredients for the food, health, and renewable fuel markets. Now, think of them as the behind-the-scenes supplier whose products end up inside things you use every single day, even though you've never even seen their name. It's unglamorous, industrial, and easy to overlook. Again, this company was printing losses one after the other, and they were expected to lose about 3 cents per share coming into the most recent quarter. Much to everyone's surprise, they actually printed a 5-cent profit instead. This is actually the third quarter in a row of beating expectations, and investors are just starting to catch on, with shares rising about 20% of the report. Gladly, signs point to even more good times ahead. Just like the previous stocks, we have meager Wall Street coverage, but the one analyst on board is pounding the table with a buy rating plus a price target that points to 70% upside potential in the year ahead. Our model also gives Alto a Zen ratings of A, which amounts to a strong buy recommendation, and actually puts it in the top 1% of all stocks for its fundamental profile. By the way, the Zen ratings are updated every day on our quote pages, so be sure to check out the latest data on WallStreetZen.com. Now, Arlo's component grade profile is strong across the board. We're talking about top 19% of all stocks for financials, top 19% again for value, top 17% for safety, top 16% for momentum, and coming down the home stretch, we have top 13% for growth and top 5% for sentiment. A lot of cheap stocks are strong in one area and a mess everywhere else. Alto is about as strong fundamentally across the board as you will find in any stock. The main risk here is about volatility. Again, we are talking about a low price, small cap stock, so it's going to swing more wildly than your average holding. Please consider that when sizing your position. Indeed, this phoenix has risen from the ashes and starting to print more impressive earnings reports. Gladly, it's still under the radar by the street, but the Zen ratings shines a light on why it should outperform in the months ahead. A quick ask before we move on to the next pick. If you're getting value out of this video, then please hit subscribe and the notification bell. That's because I put out fresh stock recommendations every week, and those small actions are the best ways to ensure that YouTube tells you when the next videos drop. All right, moving on to our second to last stock in 8x8 with a symbol of EGHT. Now, the pinch here is simple. This is a cheap, profitable company that ranks highly in its industry. In fact, it's the #1 ranked stock in the crowded and attractive app industry. 8x8 runs cloud communications for businesses like phone systems, video, and contact center software. Basically, all the tools a company needs to talk to customers and delivered over the internet. It's the kind of software a company sets up once and almost never rips it out, which makes the revenue sticky and recurring. And unlike a lot of cheap stocks, this one actually makes money. That includes the most recent earnings beat, 38% above expectations. This isn't a company hoping to fix itself someday. It's already profitable, already the leader in its field, and still being treated like an afterthought. Once again, Wall Street coverage is thin, but the one analyst covering it is the highly ranked Catherine Trebnick of Rosenblatt, who lands in the top 8% of analysts based on her actual stock picking performance. She sees 8x8 as a strong buy recommendation with a price target that implies nearly 70% upside potential in the year ahead. Now it's time to look at the fundamentals through the lens of the Zen ratings model. Here again, we have an upper echelon A-rated stock, this one in the top 1% of all stocks for its stellar profile. As we drill down into the component grades, there's a lot to like here, right? Top 21% of stocks for financial strength, showing it's a well-run company. Both safety and our AI timeliness signals are in the top 18% of all stocks, followed by growth in the top 8%. But the areas that really jump off the page are the top 1% showing for both value and sentiment. The risk here is consistent with the other picks. It's a low-price, small-cap stock, so the price can swing more widely on a day-to-day basis. But 8x8, we have a profitable industry leader with a world-class fundamental profile. Even better is being the top percent of all stocks for value, the very definition of a hidden gem stock. Before I get to the last pick, let me remind you to join me this coming Monday at 7 p.m. Eastern Time for my live training session. That's when I share my updated market outlook and trade of the week, which combines the power of the Zen ratings with my greater than 40 years of investing experience. It's completely free, but you do need to register. So go to WallStreetZen.com/live or click the link in the description or scan the QR code on your screen. But whatever it takes, I look forward to seeing you on Monday for more investing insights. Okay, now we close out the video with our fourth and final stock in Xperi with a symbol of XPER. This name probably means nothing to you, but what if I said TiVo? Yeah, that TiVo. The DVR that changed how an entire generation watched television. Xperi is the company behind that innovation. But here's the twist, and the real reason it's our closing stock today. The business behind the familiar name today looks almost nothing like the TiVo you remember. Xperi has reinvented itself around connected car technology and smart TV software, meaning the entertainment systems built into new vehicles and televisions. The major company reinvention is starting to show up impressively in the earnings. For last quarter, for example, Xperi flexed some muscle with a 53% earnings beat on an impressive surge in revenue. Under the hood, the newer parts of the business are gaining real traction. Now, the media platform revenue jumped 45% year over year, while monthly active users on the TiVo One platform more than doubled to 5.5 million. As Xperi expands advertising monetization across that growing audience, management believes it's approaching an important earnings inflection point. The market is starting to notice, with the stock up more than 30% over the last 3 months as of the week of recording this video. Yet there are important signals that this upward trajectory should continue for quite a while. Once again, on the Wall Street analyst side, coverage is limited but unanimously bullish. This includes another top-ranked analyst pounding the table with a buy recommendation and a target price that calls for over 50% more upside in the year ahead. Now we roll into the Zen ratings. Xperi earns an elite Zen rating of A as it lands in the top 2% of every stock we analyze, and the component grades underneath it fit that impressive story. We have a safety coming in top 11%, followed by a top 10% showing for sentiment. Best of all is the top 5% showing for growth. This is not just about earnings growth, but also consistent improvements in revenue, profit margins, EBITDA, and cash flow. Here's what that combination is telling you. The company is growing fast, the smart money is moving in, and the business is sturdy enough to see the turnaround through. That's exactly the setup you want to see in a reinvention story before the rest of the market truly catches on. I'll be honest about the risk here. On a bottom line basis, Xperi isn't fully back in the black just yet. That's because the legacy side of the business is still shrinking. This is a bet on the reinvention of the company continuing to unfold. But here's the bottom line. You've got an exciting business transition unfolding, leading to a hearty earnings beat and a sprinkle of love from Wall Street analysts. Even better is the stellar Zen ratings profile that greatly increases the odds of more upside ahead. There you have it. 4 very different stocks, 4 very different ways to find value and exciting upside the rest of the crowd is missing, all priced under $20 a share. Now, want to hear from you. Which of these 4 stocks looks the most promising? And are there any other hidden gems you have your eye on that you'd like to share with the rest of our audience? Please put it all down in the comments section below. And if you want to find more promising opportunities, then I invite you to check out the video that's popping up on your screen right now. In that one, I review 4 growth stocks I'd buy today for a 2030 portfolio.